Tesla's stock price has fallen recently because they reported first quarter deliveries. They delivered almost 430,000 vehicles, but according to analysts, they were expecting 432,000 vehicles. They missed by 2%, so obviously this is no concern in regards to the fundamentals of the business. In order to determine Tesla's valuation, I am going to look at the price to sales ratio and I am going to compare it to other companies. Then, to calculate Tesla's intrinsic value, I am going to use my Excel sheet to determine what price you should pay for Tesla stock. The price to sales ratio is a valuation metric for stocks, which is calculated by dividing the company's market cap by the revenue in the most recent year. The lower the price to sales, the cheaper the stock is. Tesla currently has a 7.9 price to sales ratio. I am going to compare it to other car companies. I know Tesla has a tech component. However, 88% of their revenue is from cars. As you are seeing on screen, other car companies trade at a less than 1 price to sales ratio. So from a price to sales perspective, Tesla looks very expensive. However, Tesla definitely deserves a higher price to sales because of its technology, growth potential, and higher profit margin than other car companies. The question is how much more you should pay for Tesla. In order to determine this, I used my Excel spreadsheet, which tells me at what price you should buy a company based on the assumptions about the future of the company. On screen, you are seeing my 7-year assumptions on Tesla, and I am going to quickly explain them. In terms of revenue growth, this company is expected to grow at around a 20% rate over the next few years. So, on my low assumptions, I went conservative with 18%, on my middle I put 20%, and on my high assumptions I put 25%. In terms of profitability, they are expecting to struggle in the next years. They currently have a 15% profit margin, which has been a record year. So I've put 15% on my middle assumptions, 12% on the low, and 18% on the high assumptions. And they have a bit less free cash flow, so this is why I went with a slightly lower percentage. Tesla currently has a 51 PE, but remember that you should not compare the PE with the history of the company, but rather with the history of the stock market, which is around 15. You should definitely pay a premium for Tesla because of their growth potential, innovation and technology, and because they are a fantastic company. This is why I went for 18, 20 and 22. As you can see, if you believe my high assumptions, you would buy this stock because you would make more than a 15% return on your investment each year. If you believe the middle assumptions, you may want to wait for the stock price to fall a bit, but it's basically there. And if you believe the low assumptions, the stock price needs to fall 40%, which could happen as Tesla hit $100 a share on January. I hope you enjoyed the analysis and I'll see you on the next one.